And on the equity side, Vetri, where is it that you are distinctly underweight yourself or in the fund positioning? Where do you see further risks? And where is it that within your overall underweight stance, if I can use that term, are you relatively overweight?
I'll just simplify that. Again, Neeraj, I should just clarify that, at least at UTI, we run a range of strategies and we do everything from relative value to out and out growth and quality investing. So there isn't really a one size fits all approach to our sector positioning. But if I were to sort of talk through some of the areas where I think there is a broad consensus in terms of, without getting into a growth value equation, but where do we think we are getting value for money? Let's put it like that. So where do we think we are getting value for money? We certainly think we are getting it in the financial space. All the commentary is about weak credit growth. But I think what we are missing is that there's been significant degree of consolidation within this sector in terms of incremental market shares in the hands of some of the large significant players. I'm not talking about M&A, but there has been significant market consolidation, market share consolidation. And I think this bunch of financial institutions is very well placed for growth in the next upcycle. The reason we are getting some of these companies at the valuations they are available today is because the market is concerned about growth. But when I said value for money, it's always a combination of some negative factors combined with a medium-term growth opportunity. So financials, lending space is something where we have comfort. The other place, which sort of goes a little bit more into not just value for money, but with a slightly contrarian thought process, is the entire automobile space, right? How many sectors in India, Neeraj, are currently running 20 to 35% below the peak volumes that the industry registered 4 years ago, right? So FY19 was the best year for automobile sales except for tractors. And the industry is running 20 to 30% below that. This is an area, again, where we think strong balance sheets, companies going through transition, no doubt. But the benefit of a bounce back in volumes, benefit of operating leverage, some addressing of the problems on supply chain can create significant positive momentum. So that's another area where, I would say across many of our strategies, we have a sort of on balance positive view. If you were to look at one of the areas where I would increasingly have concerns, the stark outperformer year to date has been the commodity space, whether it's metals, whether it's energy. In a sense, it's also a play on the disruptions and particularly what's happened in Russia, Ukraine. So I would be more inclined to start reducing exposure there because, I don't think these prices are reflective of the long-term price trends you can get. They are more reflective of the disruptions. And I think some of these disruptions will sort of ease out over time. So that's an area where we would tend to sort of pull back. And I would also say the staples space, it's been something that we've been worried about in terms of valuations for a while. There's been some cool off in valuations in staples. The sector has underperformed over the last year and a half, but I don't think they have yet dropped into what I would call attractive territory. So that's another area where we would still sort of stay on the sidelines in staples. High-end consumption, because of this K-shaped recovery, high-end premium consumption is doing well, but the mass market and lower is not doing as well. So that's something that we are conscious of in our positioning.